Afternoon, everyone, and good afternoon, everyone, and welcome to the NWR Virtual Healthcare Conference Investment Panel Session. My name's Mark Parhash. I'm editor of BioShares, an investment newsletter that covers the listed biotech companies in Australia. We've got a great lineup today. We've got healthcare analyst Elise Shapiro from Canaccord Genuity joining us, and we've also got two fund managers, Charlie Williams from HB Biotechnology and Hashan De Silva from KPRX, a newly formed fund. So welcome, everyone. Thanks for making the time to be available.
Good to be here.
So, for kick things off, we've had 9 biotech listings in the US in this year. We've got one planned next month, which is Blink Lab, raising $7 million. The Nasdaq Biotech Index is up. Last count was up about 21% in the last 3 months. So is biotech back? Who wants to kick things off? Elise, do you want to? What's your view on the biotech sector and the interest from investors? Are investors starting to? It's been a tough couple of years. Are investors starting to sort of put their hand up and start to get interested in the sector again?
Yeah, for sure. So look, thinking in the US, the XBI broke 100 for the first time since early 2022. So, we have had a really strong year to date in the sector in the US. It finished Feb up 13% month on month. And I think this is the best 2-month start to a year that biotech has had since 2019. So, we are getting a feeling that macro factors are setting biotech up for a good 2024. Inflation's receding, the economy is strong, so investors are starting to feel optimistic about a soft landing. And I think specialists are also hopeful that declines in rates will help biotech stocks, especially the mid caps, with a return to more spirited growth, hopefully to continue in a higher risk and higher reward development opportunities. In terms of fundraising, and we were talking about this just before, the year is looking extremely strong as well. In terms of IPOs and follow-on offerings, for 2024 year to date, so that's about 70 days, that's already gotten to about 50% in terms of the dollars raised compared to the whole year 23 financing. So again, a really good indicator. I think, the bear market is hopefully over, and now we are starting to see good data points and good clinical catalysts getting rewarded, which is, also opening up the financing window. In terms of, how does this translate to Australia? It is hard to tell because the investor appetite and the investor kind of level of specialization is different. But I think, I think it definitely is a good thing that the global trends are returning and that, companies are getting rewarded for good data. I think the appetite for later stage assets is always going to be higher here than it is, or it's going to be, the appetite for earlier stage assets is going to be weaker here than it is in the US. But we are seeing really good innovations across Australia with best-in-class molecules targeting sizable markets, in areas with limited competition. There are areas with strong competitive advantages and strong intellectual property. So, I think it's a good reflection. But whether this year is going to fully outperform 23, I think it's a bit of a wait and see.
Okay. Thanks, Elise. Hashan, you've just launched your fund. Have you got perfect market timing? Have you? It's a pretty good time to launch. Can you tell us a little bit about the process of raising your fund? How long it took? How much you raised? And what that fund's all about?
Yeah, no, I've learned a lot raising a fund that I didn't know when I went into. So my fund, I guess, is a little bit different in the sense that it's predominantly a private market investor. We do private and public, but it predominantly invest in unlisted entities, and that means our fund is locked up for has a 10-year life, and so that is limited where I can raise money from. And one of the kind of key learnings that I had was when I'm speaking to institutional investors, the parlance is institutional LPs or limited partners. The way that they kind of recycle their money is they invest in a fund, and then the fund exits and returns their money back to them, and then they can invest in the next funds. And so in a bear market, they're seeing less exits. They're getting less money back into their coffers, and therefore they have less bullets to fire by investing in new funds. And so that kind of perpetuates the bear market a little bit because it's much more, even when the smart institutional investor wants to allocate more into venture capital or wants to allocate more into healthcare, they can't because the funds they invested in 5-10 years ago aren't exiting. So that's kind of the insto land. In the high net worth or the family office land, the thinking has changed in the sense that now you can go into a private debt fund or even do private debt investing yourself and make 8 to 12%. 2 years ago, you're likely to make 3% and you take astronomical risk, right? So the risk is lower and the return is higher. So the conversation with the high net worth and family office market is, what does it look like over a period of 10 years? And can you generate an IRR better than 12%? Often the answer is yes, but there's much more risk that comes with it. And so where we've found our successes is in the family office market, where the family office money was earned or generated through non-property and non-mining, so tech family offices or industrial family offices. And so that's one of the other reasons why it's really hard to raise money in Australia. I'd say 95% of our family offices are property or mining. And so they don't understand tech and don't understand VC. And then the other kind of bit of money that we got is from healthcare entrepreneurs. So these are people that have started healthcare businesses and exited and made a lot of money along the way. And so with that, we've been able to raise 40 million in Cornerstone Capital. The fund has a hard cap of 200 million. And so, we'll see where we get to between 40 and 200. Just the other interesting dynamic that I'll quickly touch on before I hand back is that the big difference between a private market investor and a public market investor, right? If you have less money in the public markets, you can do better than if you have more. So what I mean by that is, if you have 50 million, you can write smaller check sizes, you can be more nimble, and you can invest in more assets and generate a better return than if you had 500 mil. Now, that's not necessarily the case in the private market. And the reason for that is, often in a bear market in particular, you have to write the 100% of the check to fund that company. So if a company needs $20 million to do a phase 2, and you can invest 2 million, well, you're not generating better returns. You kind of just, you've wasted that 2 million. That 2 million is going to be spent, and you're not going to get to a value inflection point. So you actually have to have a critical mass of capital in order to be able to invest in the number of companies you want and create a portfolio that you want. That's a big difference between private and public. And so, yeah, with our fund, we're not going to invest in as many opportunities with 40 million that we would with 200. And I think that creates a less risky portfolio than trying to invest in 20 assets at $40 million.
Do you like to co-invest then, to sort of share that risk and make sure you've got that sufficient capital?
Yeah, so we syndicate. So the kind of the tier or the waterfall is we go to our investors and say, we've got this fund, we've got this raise, we're doing 5 million, there's another 15 million. And we see if they are happy to tip in more. And then we will syndicate with other institutional investors. So if you look at Curvebeam AI as an example, we were the first institutional investor into that fund. Subsequent to our investment, there are 6 other institutional investors, Firetrail, SG Hiscock, Unity, Acorn, that we syndicated subsequent rounds with. And that really, de-risks future funding and allowed us to IPO Curvebeam in a very bad market.
Okay. Charlie, now with your fund, and we were talking before, you invest, I think you said about 80-20 into the US, 20% into Australian stocks. How are you seeing the market in the US here, and what's your experience been the last couple of years? How have you weathered the storm? Have you been doing well or not?
Yeah, it's been incredibly tough market conditions, as Elise alluded to earlier. I think the market peaked at around, in the US, it peaked in February 2021, which coincides with our launch date as well. So we've been through the ringer, but come out the other side extremely well. Elise mentioned the XBI, that's the index that we track, where since launching a gross 50% ahead of that to date over the last 3 years. So we're very happy with that. Clients are happy with the returns. And one of the defining features of the last couple of years is the macro environment and interest rates really knocking around risk assets. And the funny thing about biotech is that it is, if you're not a specialist investor and you don't have conviction in what you're holding, the generalist investor is one of the first things you're going to let go of. And that's, you know, where we've seen some real drawdowns during those years in 2022 in particular, and the periods where there was a flight to safety. For example, when Silicon Valley Bank fell over in, I think it was March last year, biotech touched fresh 5-year lows. Again, when the Fed around September was signaling higher for longer rates, XBI touched again at 5-year lows. Hashan mentioned family offices and investors saying, "Oh, well, you know, the world's falling apart. I can get 8% on my money in a private debt fund." But what you have to realize is that if a market's at its 5-year lows and there's nothing fundamentally wrong with these companies, now you have to think of biotech as the outcomes of a biotech, whether it's a phase 2, phase 3 result and regulatory approval, has nothing to do with the economic environment as long as they have enough cash to operate. And so if you've got investors on the other side that want to give you their shares at an extremely low price, we're very happy to take them off their hands at simply because people are scared about interest rate risk. It's got nothing to do with biotech. And you look now from November of last year, where people are saying, "No, I just want to put my money in cash." We've done over 30% in about 4 months. And Elise said it's been a great start to the year. And the great thing is, it's data sets and not interest rates that have been moving the market in the XBI, and we think that's going to continue into the coming years as interest rates either stabilise, and if they go down, well, that's an even better tailwind for a sector like biotech.
I guess the challenge over the last year, particularly the last year, has just been funding, and if biotechs don't have access to funds, a lot of them have been forced to raise at massive discounts, and which hurts investors. So
look, that's correct, and that's so one of our key screening criteria. And unlike Hashan, we only do listed stocks, but one of our key screening criteria is making sure that a biotech has at least 12 months. That's an absolute minimum. We prefer more than that, 18 months to 2 years. And if you have a look at the disparity between the balance sheets of, say, US companies and how well they're capitalized in their runway compared to the average Aussie biotech, there's a huge difference. During those periods last year, you'd screen for companies with about 2 years of cash, trading less than their cash backing, and there's nothing wrong with their science. And those kinds of stocks are flying at the moment. But I totally agree with you. Funding is critically important in this industry.
So a question, I'll go to Elise first and then back to Charlie. So in terms of technologies, what's hot at the moment? What do you see as there's always something that piques in investors' interest more than other technologies. What do you see as being the technology that investors should be looking at the moment?
No, I don't think you can look at just one. As Charlie and Hashan would know, we do like to take a basket approach to biotech investing to spread the risk. But tech's changing and evolving all the time, and there are so many subsets within the sector that you can really delve into to find something interesting. So last year there was a lot of interest, and even overnight a bit of interest in radiopharmaceuticals on the oncology side. Last year, antibody drug conjugates was really hot. A lot of the really good assets there have been acquired. Oncolytic viruses are interesting, and novel cell therapies, so not your kind of more traditional cell therapies, are really interesting ones. Another point that I think you really can't ignore these days is also the obesity boom led by GLP-1s. Unfortunately, nothing in Australia on the listed side, but going through a few numbers before this chat, there are 124 medicines in the current obesity pipeline. 61 are in phase 1, 47 are in phase 2, and 8 are in phase 3, and 8 are on the market. So, that's a massive market. And those GLP-1s really snuck up on people because some of these have been around for a long time. But, with the success we're seeing in GLP-1s and novel mechanisms coming through, I think that's going to be, a very, very hot and hyped up area, just given the population size as well.
It's interesting the perception. I know if you go back 15 years back to metabolic pharmaceuticals, it was trying to develop a injectable obesity drug, and the comments were no one's gonna inject themselves for obesity now. Look at Novo Nordisk and Eli Lilly, and they're shooting the lights out. So, Charlie, what do you see? What do you see as some hot areas of biotech at the moment?
Yeah, look, I think Elise mentioned a couple of the really hot areas that have been around. You would have been forgiven last year for thinking there are only two things that investors were interested in, and that was obesity and ADCs. The really interesting thing about radiopharmaceuticals, and we've got a couple of good quality companies in this area in Australia. Just last night, Fusion Pharmaceuticals was acquired by AstraZeneca. It's an alpha particle emitter. Last year, Raise Bio was one of the few IPOs last year. They raised 350 mil, a bit over 350 mil US at IPO, and was acquired at 100% premium only 3 months later. And it shows you the interest there is in this area. Now, really, really importantly, all of the companies that are getting acquired in this area, they're therapeutics, they're not diagnostics. You hear people talk about diagnostics as really important in radiopharmaceuticals. Large pharma, I mean, they largely don't care about the diagnostic portion of the portfolios. It's all about the therapeutics. You see the Pluvicto, the AAAs, in NETs, all of these alpha particles, they're all going after the diagnostics. I think this is going to continue. You've seen a lot of money going into also private rounds in the US, going into radiopharmaceuticals. I think that's going to continue. One area that we I hate to bring up the AI word, but there is there is a lot of focus on AI and how it pertains to biotech. Now, I don't think it's going to change things overnight as to how things are developed, but increasingly it's becoming a ticket to play, and probably about half our portfolio companies, and we just added one the other day, fundamental to their discovery process is having not just an AI algorithm, but proprietary data sets and expertise in the wet lab to validate that. Because it's a sort of a rubbish in, rubbish out principle. You can have the best algorithm in the world, but if you don't feed it and train it with great data and then validate that data, then it's going to spit you out rubbish at the end. So I think that's increasingly going to be a focus for companies moving forward. And one of the areas we're seeing that is in the protein degradation space. And again, an area is really hard to get exposure to here in Australia. And we've got a couple of companies like that in our portfolio.
Hey, I'll move to Hashan. Just with moving to the private biotech space. What are the challenges? Is it what for private biotech companies in Australia? I mean, do they have sufficient access to capital compared to the US? And are there any advantages that the privates have in Australia compared to the US?
Yeah, it's a good question. So, I mean, the key challenge for privates in Australia is funding, right? So, if we look at the landscape of private market healthcare specialist VCs, there's probably 5 in Australia, the majority of which really cluster towards the pre-seed and seed stage investing. So, spinning IP out of universities or funding discovery work. And so, you look at who's left to write the $20 million, $30, $40 million check to fund the human trials. There isn't that many people. So there aren't that many institutions. So that's why we see biotech in Australia listing on the ASX and listing so early. And I think, I've said this before, but we owe the ASX a debt of gratitude, because without the rules that allow biotech companies to list as early as they do, I mean, I don't think we'd have much of an industry today. Right, so a lot of the biotech VCs have come about in the last few years, right? Charlie and my fund, it didn't exist 2 years ago, right? Then you got 10 Mile, and you got Tin Alley, didn't exist 2 years ago, right? So majority of the capital has come in the last few years, not 5 years ago. So I think then we get this I guess spiral of death, if you want to call it that, where companies do the trial they can afford, not the trial that they should do. So let's say they can only raise 5 million. They're like, oh, well, we can do this trial with 5 million. But in reality, they should be running a randomized controlled trial with $20-30 million. And so we get these companies that exist for a very long time, not doing the things that they should do. And I guess Neuren is an example of that, right? They weren't doing the things that they should have done because they didn't have the money to do it until very recently. And then the question is, I mean, if we got such great assets and such great valuations, why aren't the US investors kind of piling into Aussie private companies? And I actually don't know the answer to that question. I think there's a certain element of snobbery where they're like, well, if UCLA and bloody Harvard can't do it, why can University of New South Wales can, or whatever it might be. And I think the other thing is the time zone. They just don't want to work outside of their time zone. What do we do better in Australia than the US or the rest of the world? I mean, it is so much cheaper to run a clinical trial in Australia for every single disease state than any other market in the world, ex-Asia. But what we have is a ethnically diverse population that mirrors the major markets, right? So you can go all the way to phase 2 and not have to worry about seeing the FDA until the end of phase 2 meeting. You can do it all in Australia. And you get the government essentially underwriting half of your R&D costs with the 43.5 cents R&D tax rebate, most generous in the world. And so I think that, and so when I speak to investors in the US, when I tell them why do Australia, I say that we can get phase 2 stage companies at a seed stage valuation versus the US, and we can get the government to underwrite half our R&D costs in the future. You don't get that in any other market in the world. That's what.
So is it part of your process trying to get syndicate sort of investors from overseas to invest here in private companies? Is that part of what you're doing?
Yeah. So when I say investors, I should mention fund investors when we're capital raising for our fund in the US, but we do speak to US VCs as well about investing in Australia. I mean, they kind of push back for what I think are very stupid reasons, like, oh, that we don't want Aussie dollar exposure. Well, come on, man, you can hedge that out very easily. But when we do, I mean, it's tough. They just don't want to invest in Australia.
So Hisham, what could the government do better to support the sector, if anything? I mean, you talked about the R&D tax rebate. That's great if you've got the money. If you've got $20 million to spend, you get, what do you get, $8 million back at the end of the year. That's great. But if you're, you start your business, you don't really have the funding to get there, to get the tax rebate. So what is there anything that the government can do better?
Yeah, look, I mean, the biggest and best thing the government could do is change the way they regulate superannuation funds. The idea that everything that the government has imposed is anti-innovation, right? For instance, the super fund has to write you a letter if they underperform the market over a 2-year time period, telling you to pull your money and go to another super fund. I mean, that is actually legitimately ridiculous. Right? So super fund needs to be taking 30, 40, 50-year view on your assets because you're not retiring in 2 years, right? And if the government's making you look at a 2-year time horizon, you cannot invest over a 30-year time horizon, right? And the idea that every super fund will beat the market is also ridiculous because they're so large now, they are the market, right? So by definition, 50% of them will underperform over some time horizon. So those kind of rules has meant that if you look at the exposure of a super fund to private assets, it's really, really low, right? So if you look at Harvard Endowment, Yale Endowment, Caltech, or the California Pension Fund, they said that about 30 to 40% of their money is allocated to private assets. You look at Australian super funds consider a 15% allocation to be over allocated to the private market. And I think the other thing that they need to do is, right, so if you look at people that put money into super funds, the young people, in their 20s and their 30s, the money that the super fund generates is the least important part about how they will be when they retire. The most important part is what job do they have and how much money do they make before they retire. So there's a big argument that super needs to be allocating money into these growth industries in Australia, biotech, renewable energies, et cetera, to create the high-paying, knowledge-based jobs that their members will need to get in the future in order to be better off when they retire. And at the moment, that is not a consideration for super funds. Only consideration is how do they go versus the market. And I think that's the wrong way to look at it. Also, when you look at the the Future Fund of Australia, I mean, they have zero investment in venture capital in Australia. So, one could argue that the Future Fund of Australia doesn't really care about the future of Australia if they're not investing in venture capital in Australia. So I think, they need to think more holistically.
And it's a really interesting, we always come up against this in Australia of we do have fantastic research capabilities. I did this analysis just the other day and figured out that per capita, we are actually the highest production of biomedical research in the world. And even on an absolute number, we're only second to the likes of the US and the UK. But only slightly behind the UK. So we generate a huge amount of biomedical research in this company. We just fall down so woefully, and we've talked about a number of these things. Hashan's pointed out a few of these funding gaps. We're just so woeful at translating that into commercial stage biotechnology companies. A lot of that is funding, and I think a critical mass of understanding what good looks like from a translation perspective as well.
Yeah, there's a real disconnect there, isn't there? There's, there's this paucity of capital for private companies, and yet, our superannuation funds, I think it's the fourth largest pool of funds in the world. So, just moving on to a question for Elise and for Charlie, just about M&A. We've seen the first acquisition in process of Volpara for Para Health Solutions in 2 years. So the last one before that, I think, was ResApp Health. Elise, what do you think? We're going to start to see some more M&A activity in the space?
Yeah, like I don't think Volpara is a proxy for M&A appetite from internationals. I think we should look to, what's going on globally to get an understanding of, big pharma, big med tech, or biotech appetite for acquisitions. In 2023, there was pretty strong appetite for M&A with a few, I wouldn't call them mega deals, but pretty large deals with, Pfizer and Seagen and a few others. But we have had a really good start to 2024 as well. A few key thematics for 24 in oncology. So you had J&J acquiring Ambrx, you had Merck buying Harpoon Therapeutics, and then neurology is also a really hot space at the moment with a lot of attention, on in the schizophrenia space. So I think M&A does come back. I think companies are looking for different things now versus what they used to look for in the past. I think, your big pharmas are probably a little bit more risk averse at the moment. So they're wanting a little bit more clinical validation, and ideally, something kind of approaching or having that kind of, at that phase 3 stage where you kind of do have a very good understanding of whether a drug works or not.
Charlie?
Yeah, look, M&A is definitely back. Have a look at the stats last year. There was collectively across Big Pharma around $150 billion of acquisitions last year. That's the second highest year on record. And by number of deals, it was one of the highest. And it was across a number of different areas. You saw immunology and inflammation, things like Prometheus, which is not surprising. You've got some major blockbuster drugs for these large pharmaceutical companies facing loss of exclusivity in the next 5 years. Humira came off patent last year. That's a multi-billion-dollar drug for AbbVie. You've got Stelara coming off. Keytruda will come off later in the decade. You're talking about tens of billions of dollars for each of these assets that is going to make a big hole in their revenue. Large pharma companies, to put it in context, they spend, say the top 20, they spend around $50 billion collectively on their own internal R&D programs. They complement that with, in excess of that, usually $50 to $60 billion, and sometimes more in the cases of last year, of acquisitions out of small to mid cap biotech companies, and they're looking to plug the gap of their future revenue. And so all of those areas that Elise mentioned, I think that they're going to keep being plugged. 50% of the investment market is oncology. We're going to continue to see that. Radiopharmaceuticals is hot. We saw that from the couple of acquisitions that have been, in the last 6 months. And you're going to keep seeing it again in immunology, inflammation. You probably keep seeing it in the obesity area. If anyone cracks the oral GLP-1, they're going to be very rich. But we've had a few hiccups on that to date. And I agree with Elise. Neurology is increasingly important to pharmaceutical companies, but they're looking for latter stage assets with validated results.
All right. We're just about to finish up, so I'll just end with one question for each of you if you want to address it. What do you prefer? drugs or devices or diagnostics? Do you guys have a preference when you look at companies, or you're a bit agnostic?
Maybe I'll
I'm happy
kick
to
off.
start. You want to go, Hashan?
Yeah, I'll go. So I mean, I'll just compare drugs and devices really quickly, right? So the key difference is that with a drug, all the work gets done before you get approval. And with a device, it tends to be that all the work needs to be done after you get approval, right? So one of the reasons why drugs is good is because you do the clinical trials, you know who's going to pay for it, you know who the market is, and once you've got approval, most of the hard work's done. Not the case with devices, right? Getting a 510K is often the easiest thing that these medical device companies will do. And so subsequent to that, you need to run a clinical trial, you need to build reimbursement, you need to change clinical practice. And so people say, well, devices are easier than drugs. I disagree. I think drugs are easier than devices. I mean, when you get a new device approved, you have to go and teach the physician how to use your device and get them to do something different. And that is difficult.
So by having said that, Hashan, do you prefer then to invest in drug development companies over device companies?
And no, so I'll answer it very politically, saying that we're 100% bottom up. And so we look at each asset on its own merits, regardless of whether it's a drug, device, or diagnostics. But maybe your answer can hint that maybe I tend to favor drugs a little bit more.
And Charlie?
So I completely agree with Hashan's assessment of where the risk profile lies in drugs versus devices. And like Hashan, we invest across devices and therapeutics. I often find diagnostics extremely difficult, and we tend not to invest in them too much. But again, if our portfolio is any indication of how we see where we see value, we only have one exposure to a device, and the rest of it is therapeutics. And that's all because we screen everything on a risk-reward basis to make it into our portfolio. And more than 95% of our exposure is to therapeutics.
And Elise, you probably sort of cover across the board. Would that be correct?
Yeah, I cover across the board, kind of echoing the thoughts of Hashan and Charlie. You have to invest in good quality companies with good quality assets that are well funded to success, that can actually achieve those clinical, regulatory, and commercial milestones. So for me, it's more of a quality game. You do have to note that on the ASX, there are a limited number of quality healthcare companies or even listed healthcare companies to invest in. So you're kind of at the mercy of what's listed on the market, or even what we have domestically. But I think we are seeing some really good progress across the board with a number of companies. So I think it's an exciting space at the moment, and I'm really looking forward to seeing that grow.
Okay, well, thanks for your time, everyone. Hashan and Charlie, good luck with your funds this year. I hope you hit it out of the ballpark. And Elise, thank you for your time, and hope you make some good calls out there. And thank you for Matt from NWR for putting this together, and we'll wind up there. Okay, thanks, guys.
Thanks, Mark.
Okay.
Yeah.